Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted to be joined again this week by Tom Hibbert, our Chief Investment Strategist from the Chief Investment Office. Morning.
Hello, everyone. Good to be here again.
And as our regular listeners will know, we are here to really try and cut through all the noise, and there is indeed a lot of noise going on at the moment. Demystify what's going on in a simple and easy to understand manner. And hopefully then you can feel a bit more informed, a bit more confident and more in control of your financial future. So this week, it feels like a bit of a part two of last week's podcast.
Yeah, it is.
And we are focusing on the single biggest pressure point on global markets at the moment, which is the battle for the Strait of Hormuz and what it's doing to inflation, oil and interest rates. So let's grab your coffee and let's dive on in there into that Strait of Hormuz. So what is actually happening here, Tom, and why?
Yeah, so the Strait of Hormuz is the key linchpin of the conflict.
Right.
And that is because it's so important for global energy supply and trade. Roughly 1/5 of global oil and natural gas flows through the strait.
Okay.
And about 5% of global trade. So the fact that it's been paralyzed on the back of this conflict represents a significant supply side shock. Yeah. And as I say, it's become the main sort of linchpin of the conflict, where both sides, Iran wants to keep the strait closed and the US desperately wants to reopen it and alleviate the supply chain pressures. So the longer the strait remains disrupted, the greater the risks that this energy shock spreads through supply chains and generates a broader sort of inflationary surge, or that it becomes a structural inflationary surge.
I guess because it's not just about the price of oil itself, it's that when oil spikes, that seeps into every corner of the economy because it's just the basis for so many
oil
things.
is basically everything is a derivative of oil. Even other commodities are derivatives of oil, because oil is the main thing that is used in their extraction and processing, for example. So, and energy is so central to the global economy.
Yeah, hence a big issue. So specifically about oil prices, what's going on all in this fog of war?
Yes, we're seeing a lot of volatility.
Yeah.
And you look on Monday alone, we saw massive moves, and the Brent crude price surged to $120 a barrel before falling back down again on the same day, and was again soft on Tuesday when Trump came out and said that the war was nearly over, and then sort of reality struck again, and it rose again. So that the oil price is still, the Brent oil price is still above $100.
Okay.
Which is a significant rise. It's up sort of 67% for the year. And the Iran shock now sort of makes up about 1/3 of today's oil price. So it's a really significant premium on the back of this shock. So Iran's, I think their strategy now is that they want this conflict to be as prolonged as possible. For them, it's about resilience. And the longer that they can keep the conflict going, they can stay resilient. And the longer oil prices remain elevated and the Strait of Hormuz remains closed, the US's resolve for war will be eroded. And it'll increase the sort of international and domestic pressure within the US to strike a deal or to somehow bring an end to the conflict.
Yeah.
And, you see these things with wars. Wars are easy to start, very easy to start. But they're quite difficult to finish.
Yeah.
And we've seen that, Putin thought his invasion of Ukraine would be a very short affair.
Yeah.
And, however many years later, it's still going on. So, I think the US there's a danger that this conflict becomes.
But there's been a bit of a shift in tone, hasn't there, from President Trump this week?
Yeah, good point, actually. So, obviously the main goal of the administration was they want low energy prices. They want low oil prices. And he really spoke about that. And
this is causing the opposite.
Suddenly now he's like, first he was saying higher energy prices are a reasonable cost for the destruction of the IRGC, the Iranian regime, effectively. Right. And now he's saying, actually, high oil prices are great for America because we're a net oil exporter and we are, very, very energy independent.
So what is that? Is
it's a
that
bit of a U-turn.
Is that economic positioning? Is it political messaging?
I think it's pure political posturing.
Yeah.
Trump is very
good
prone to that, isn't he?
Yeah.
I would say you're good at it, or he does it very obviously, doesn't he? Everyone can see what he's doing.
Probably a bit of both.
Yes.
Last week we talked about the upward pressure on short-dated bond yields, particularly here in the UK, because we're the opposite of the US, I guess. We have a lot less energy resilience and greater sensitivity to energy prices.
Yeah.
So just a reminder, when gilt yields rise, markets are pricing in higher interest rates or delays to the cuts that everyone was expecting.
Yes, that's right. And we've seen a lot of upward pressure on short-dated gilt yields.
Okay.
So, for that reflects more of the sort of short-term interest rate trajectory.
Right.
So the market, the 2-year gilt yield,
Yeah.
for example, has risen from 3.5% at the end of February to a little over 4%, 4.1% at the moment. So that's an increase of over 0.6%, 60 basis points.
Yeah.
And that, if you compare that to the US, we've seen a rise, but only 30 basis points, so half the size. And in Germany, which is another sort of key European bond market, a 40 basis point rise. So the UK has been
substantially more.
We spoke about that last week, but it's good to be aware of that dynamic.
So what does that mean then for the trajectory of interest rates? Perhaps if we start.
Yeah, if we look more
UK,
broad, I think because we focused so much on the UK last week, I think this week we now have 3 major central bank meetings. We've got the Federal Reserve in the US on Wednesday. We've got the Bank of England on Thursday. We've got the European Central Bank on Thursday as well. So I think we can do a sort of broader investigation this week. And, the Bank of England will just nail that one quickly. They were expected to cut rates at their meeting this Thursday. That is now very unlikely. And markets are even starting to price the possibility of rate increases this year, which I think is a little bit premature given the negative momentum in the UK economy. We spoke about that last week. The Federal Reserve, if we look at the US, this is really interesting. Much more comfortable looking through the shock because they're more energy independent. They have this vast oil reserve. They're net oil exporters, the biggest oil producing nation in the world. The US economy is more insulated from the shock. But also, if you listen to people on the FOMC, which is makes interest rate policy, Governor Christopher Waller has said that the energy spike is a one-off event. They'll look through the supply side shock.
Right.
And the FOMC, as its makeup today, or as Kevin Walsh is going to be the next Fed chair.
Yeah.
He's more likely to look through the supply side shock. So the Fed, I think, is
so they don't see it as the beginning of sustained inflation.
No,
at this
and
point
we've
in
got
time anyway.
again, you've got negative momentum in the labour market.
Yeah.
So the US non-farm payrolls report last week was surprisingly weak. It's a volatile measure, so it was surprisingly strong in January. But putting that aside, there is a significant sort of deterioration, not an extreme deterioration, but quite a significant deterioration in the labour market that I think means that a rate cut would be welcomed by the market here. And the FOMC is in a better position and more sort of open-minded about potentially obliging and providing that rate cut. So the Fed more likely to look through it.
And then Europe? You mentioned the ECB.
So the ECB is in a different position because they've already cut rates quite significantly. They were already at what they perceived to be the neutral rate, whereas the Fed and the Bank of England were still restrictive.
Right.
So inflation
restrictive. Just remind us what restrictive means.
Fighting the battle against inflation.
Okay.
Europe were already at neutral. So now they are. I mean, President Christine Lagarde has struck a more hawkish tone in response. So she's emphasizing that the European Central Bank would act to prevent a repeat of the previous inflation surge. So I would say relative to the Federal Reserve, the ECB is now prioritizing inflation, whereas the Fed is like, we think this is a supply side shock. We're going to look through it and are more likely to cut rates. The ECB is saying we might have to hike rates, and we would do that if we deem it necessary.
Okay, so all quite different across the 3 different.
I think there's an interesting
banks.
divergence, which is dependent on what policy is at the moment and what the outlook is.
And so CIO will be keeping an eye on that over the next week.
Exactly, I think that's the key thing. I mean, me particularly because we've had good guidance from the Fed.
Yeah,
and we've had signals from the ECB. I haven't seen the same from the Bank of England yet. So the key thing I'm watching this week is what will be the guidance from the Bank of England on the back of what I expect them to hold rates. I think a rate cut now is unlikely, but how are they approaching and thinking about this energy shock, and what is the new interest rate trajectory in the new world that we have? I mean, a month ago the world looked completely different. So central banks are recalibrating, and the market is trying to garner what the interest rate outlook is in this new world. It's really fascinating at the moment. Lots going on, but that for me this week is the key thing to look at.
Thank you. So let me sum up what is in my Canaccord takeaway coffee cup this week. The Strait of Hormuz is now the global inflation trigger point. Talked about that in some depth.
Absolutely.
Oil remains highly elevated, and that's likely to keep inflation and interest rates higher for longer. Although we've talked about different situations across the UK, the US and Europe. And markets remain volatile, really, because of all this that's going on. So as usual, we would say diversification, stay invested. Those are the things that remain key.
Absolutely. I mean, markets have been broadly quite resilient still. And, the corporate landscape is still very strong. So stay invested, I think, is a good message.
Thank you. Great. Well, I hope you enjoyed the Canaccord Coffee Break podcast today. Don't forget to hit follow so you never miss an episode, Spotify, Apple, or your podcast channel of choice. And if you've got any thoughts you want to share, any questions you want to ask Tom, please do drop us an email at coffeebreak@canaccord.com. Many thanks.
Thanks, Jane.
Thank you.
Thanks for listening, everyone.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.